Good day, Murray Gunn here, and today I am looking at the British market. Over the past few weeks, headlines about the UK economy have made particularly grim reading, with gross domestic product, the output of the economy, contracting by a record amount in the second quarter of this year. At EWI, of course, we don't pay attention to what the news says, but we do pay attention to when it occurs. And so it's worth noting that this grim economic news comes more than 2 years since the benchmark UK stock market index, the FTSE 100, topped out. The old adage of sell in May and go away certainly worked out in May 2018, because since then the FTSE has been in a bear market. The stock market leads the economy, and so it's not surprising that we're seeing the bad economic news now. The question is, of course, whether the bad news marks the end of the downtrend. Well, if we look at a broader measure of the UK stock market, the FTSE 250 index, we find it very interesting that the bounce from the March low ended almost exactly at the 0.618 retracement of the dramatic decline. 0.618 is the inverse of the golden ratio 1.618, and so a turn at such an important ratio is a strong clue that the bounce has been corrective in an ongoing downtrend. The Elliott wave count of the FTSE 100 itself also suggests that the bounce from March into June was corrective in nature. Since then, the FTSE might have traced out a series of first and second waves as it stair steps lower. The critical resistance level is 6297, which must hold for the directly bearish analysis to stand. But if it does, the British stock market might be set up for a potentially dramatic decline in the weeks ahead.